Welcome, welcome, welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn with Focus Compounding, on air live with Geoff Gannon. Geoff, how's it going today?
It's going very well, Andrew. How's it going with you?
It's going great. We hope it's going great with everybody else as well. If this is the first time you're tuning in with us, thank you so much for joining us. Be sure to check out all of our content that we push out into the investing universe. The best way to do that is to follow me on X at Focused Compound. Go to focuscompounding.com to get access to investment write-ups from Geoff going all the way back to 2005. And of course, if you're interested in learning about our money management services, you can go to focuscompounding.com, click the Invest With Us tab, or reach out to me at andrew@focusedcompounding.com. So today is May 9th, 2024, Geoff, and we're going to talk about the Berkshire Hathaway annual meeting. So this was the first meeting that... first annual meeting for Berkshire Hathaway in a very long time, where Charlie Munger was not up there next to Warren Buffett. And it was definitely very odd from that perspective. Very sad. Obviously, he passed away. He lived 99.9 years, as Warren had told everybody. But I thought this meeting was pretty special. It was pretty special. It was pretty bittersweet. I have a good amount of thoughts about it. Okay. Buffett, I thought, gave a lot of tidbits about some interesting things that we could talk about. But before we do that, just, overall, generally want to hear how your Berkshire experience was, what your thoughts were on this year's annual meeting, and we'll just go from there.
Well,
we also have, sorry, not to cut you off, but we also have a bunch of questions from people on X that have sent in for us to go over about Berkshire and Buffett. Yeah.
So, my experience in Omaha and everything was great. I was in Omaha. I had about 15 meetings with people, met more than 15 people talking with them. Some of them probably listened to the podcast and whatever. And those were all great. So that whole overall weekend experience, and actually it's like almost a week. It's like a few days before and after for me. But that whole experience was great. And then that's different from necessarily some of the things you talk about, the bittersweet and stuff is the stuff that happened at the actual meeting that people can have watched. And I guess CNBC covers it now, right? Like, actually airs it, I believe, right?
Yeah.
Yeah. So that meeting, I wouldn't say that it was the most uplifting actual annual meeting that they've ever had, Q&A session and stuff, but it was a very energizing weekend and stuff for me being there and talking with other people and stuff, well beyond just the Berkshire part of it. Just the experience in Omaha was great.
Yeah. And this was the first year that they broadcasted for people live over the internet and CNBC, the little Berkshire movie that they do before the annual meeting. Did you have a chance to watch that? Yes.
And I think Warren said, that's a lot of work for the rights and stuff. And I was like, yeah, that's pretty impressive because, the deals that they strike on those things, those actors and stuff do not agree to appear in character if you're going to air that on TV.
Yeah.
So some people got paid a little more money for those appearances and stuff. Someone cut some checks to, whoever, Desperate Housewives, Bryan Cranston, whatever. Some people got paid a little bit more, I bet.
Yeah.
So I'm sure it was a lot of work to do that. And that's nice that they did that basically special for Charlie.
Yeah, it was a dedication to him. The part that I thought was funny was, I think it was like after the Breaking Bad bit, or this was part of the Breaking Bad bit, where he was sitting in his office and he was eating peanut brittle, and he basically said like, "Yo, peanut brittle, bitches," or something like that. And I've never heard Charlie say that before, so I was just like, "This is great." I thought it was funny. I've always wondered. I'm like, what are we missing? What goes on during that film that they play every single year before the annual meeting? Because obviously, we've never actually been in the meeting itself. So that was pretty cool that they broadcast that for everybody.
Yeah, people should know the last few years that we were there, we had an event that we spoke at and stuff that had followed, right after the meeting and everything. So we were used to seeing things from like the hotel or something while prepping for an event to meet with like potential investors and things like that. That was the Willow Oak event in previous years. And then of course there was COVID before that too, so everyone, missed out on that.
So he sat up there with Greg. At one point, he did call him Charlie, which, brought a tear to my eye. I actually tweeted about that. And it was funny, too. He had said, he's like, I had to check myself a few times on that. And then he, said, I'll probably do it again. But just, absolutely incredible. What were your thoughts from Warren, right? When I said it was bittersweet, I guess my main takeaway, and you can't hold this against him because of his age, but my main takeaway was I think he's slowing down a bit. And I don't, when Charlie did his last interview with Becky Quick, where he was in his backyard, and he was talking about how much weaker he was at 99 than he was even 3 years before, I think is what he had said. I don't know. Warren seemed just different. Even from like last year, I had felt like he's probably slowed down a little bit. And honestly, it's easy to probably like internally start to accept maybe it's time and feel differently, especially because Charlie's not there, But I did feel like it was a little bit different. And somebody did point out as well that this was the first time ever, as you could see if you're watching the screen, Matt Hansen had said, just an interesting note, for the first time ever, I didn't see Buffett take a sip of Coke nor a bite of C's. So I thought that was pretty interesting. People online were like talking about that. But yeah, what was your general thought about the actual Q&A part of the annual meeting?
Well, Buffett was born August of 1930. Is that right? I believe that's when he was born. So, we're talking about someone who is, even if you're in the top, half of 1%, you're 1 out of 2,000, you're 3 sigma event or whatever. You're still pretty slow at that age, right? Because, the very best of the 90-some-year-olds are slow compared to the median 70-some-year-old. And remember, at most companies, people are retiring before they reach 70, right? There's companies where mandatorily they have to, or it used to be common that, they have to retire between, say, 65 and 72 or something like that. And so that's a long time ago. We were, what he made an amazing capital allocation thing that's going to make a big difference at Berkshire with Apple. That was many years ago. That was at the time people would have thought that's the biggest, most important kind of cap allocation decision that someone that old has ever made. But that's now years ago, and he's much older than that. So you have to be realistic about that. I've said, when people ask like, oh, do you feel that there's differences with age and thing? Yeah, yes. I'm, 38. I can't do math the same way in my head as when I was 19. Now, it doesn't show because there are tricks and things that you can do, and it doesn't matter, and you're not given a test to see how fast you can do things, and it's fine. But you double it again to when you're 76, you're a lot slower than when you were 38 and stuff, and it is a mental slowdown as well as physical over those times. And the way the curve works is that it's pretty rapid in those later years, and it's very, very slow in those earlier years, so people don't even notice. But it's just, it's the same thing as in a sports thing. You might say, oh, that quarterback's amazing at a 39-year-old or whatever, but he feels at 39 very differently when he gets hit than when he was 26 and in the prime for that kind of physically for a professional athlete, right? And so they use everything that they've learned and stuff over the years to make up for this deterioration in the raw computing power and stuff, the raw physical ability, whatever. And that's definitely slowed down, and it does for everybody by that age. There's no disputing that.
I think he did say at one point during the meeting that what used to take him 2 hours could take him 8 hours now. So that was sad to see. He did make a lot of references about like, oh, I hope I make it here next year. Making a joke about it, but also I was like, he has said it a handful of times during this meeting. So I don't know, just the reality of it, I guess, was just sad and, just different. That's the bittersweet aspect of it. But nonetheless, super impressive. As always, give great answers to stuff, inspiring answers. Still, you could tell he's passionate about the job. But yeah, it was super interesting. One thing that, go ahead.
I was going to say, actually, it was very news-breaking kind of a meeting compared to some.
Yeah.
Yeah, I don't know how much that was talked about and picked up on because a lot of it was obviously Charlie dying, and then thoughts about Buffett's age and how much also how much more they heard from the vice chairman who were up there more. So it was talk about succession and those sorts of things. But there was news on like Apple and Paramount and future things about the stock pickers and what they'll do and what other people do. And there's just a lot of stuff. And sometimes there isn't so much actual news at the meeting, because we would hear about that usually before then. So it was actually pretty eventful in that sense.
Yeah, and not only that, but his thoughts on Ted and Todd, or like who's going to control capital allocation after he passes, or the next CEO, who that's going to be. It's going to be Greg. That was really interesting. I think that was something that was new, or at least new in the public eye. One thing that, some just big takeaways, Paramount, like you had said, Apple selling it, and he had, his tidbit was he expects it to still be the largest position in the portfolio, but, you could sell down that position a ton for it to still be the largest position in the portfolio. I think he thinks tax rates are going up. I think he's worried about fiscal deficits. He said that twice during the meeting. I think he actually talked about interest rates and fiscal deficits. And he had said, look, it's not going to be the interest rates that, hurt us. It's going to be the fiscal deficits that hurt us. And he talked about tax rates going up to, because they're going to have to basically do something. So, yeah, I agree. There was a lot more newsworthy things than, what you kind of usually get out of these meetings. I mean, did it kind of remind you of like 1999 and his thoughts towards the market and stuff like that? Like, do you think he thinks the market is pretty overheated and he's not finding a lot of ideas? Or is it more so there's just nothing that is of size where they could do something big, like a monster deal?
I think it's three things. One, prices aren't that attractive for them. Two, they're so big. And three, he is the age and everything that he is. So I do think that just it might be a bit of a demotivator now to be like, oh, I'm not going to get to see another 2008 or 1970s or whatever to have a real big chance to allocate an Apple size, change the company in a meaningful way with a good price on something, and really have another big impact on that. I think that that's more it. Any one of those issues alone might not have him sort of down on that, right? Your age is what it is, but if it was a market where it's real exciting to be going in there and buying stuff and doing deals, then that might really help motivate you a lot more. If you combine them, so it's like, oh, it's hard for us with our size and with prices to do a lot, and you feel like, things are winding down in terms of being able to be really active with the company for the long term, then I think that it's harder. Yeah.
Mm-hmm. Mm-hmm. What were your thoughts on who should control the capital allocation going forward, or when he's done?
Understand his feelings now with it.
It kind of coincided. I don't know if you do know. There was a Financial Times article that came out a day before the meeting talking about Ted and Todd and how I believe they've underperformed the market.
Yeah, and we talked off the air about how I don't like those because they don't know the actual facts, and they print things as if they can read the filings and understand who owns what and everything when they can't. Yeah, and we've discussed that plenty off the air. Since I did say on the air, we can say this, that I always said that Paramount was a Buffett thing.
You did. I gave you a shout out for that. I did tweet that out. That was a good call.
But you have to read between the lines to understand that, right? You had to, first of all, guess. And we're like, it's just a guess based on what I think's going on with this company and stuff, that this is totally Buffett. But then secondly, he said stuff publicly that he does not say when he was like real down on the stock pick. And people are like, wow, he's really telling them they made a bad decision or something. No, he's saying that because he's the one who did it. So he's much more open about the stock. He wouldn't say this stock that they own, oh, what a dog that stock is and stuff that, Buffett would just want to do that, So you could tell when he made those comments before, oh, we'll see. There's been they cut their dividend, they did whatever, it's down, it's a tough business. He wouldn't have said that about a stock pick that one of the others made. So I do think that the Financial Times article probably caused that to happen, especially because Buffett reads the Financial Times every day. So yeah, I never liked that. I think I have said this before. I talked to a couple people to help them write articles for major old media publications years ago, not the FT, but other papers you have heard of. I said, you cannot use my name. I'm just helping you on background stuff to help you do this story, whatever. But let me help walk you through the SEC filings and stuff so you can understand better the Lou Simpson it was at that time, Buffett interaction between that. Because between the pension stuff that Berkshire had, the insurance stuff that they had, and the fact that Buffett and Simpson overlapped on a few things, very few, but there was an overlap, they really didn't understand how to try to guess who owned what. And so they weren't in a position to really write a good article about Simpson. You know what I mean? Mm-hmm. And so I said, here, I'll walk you through what I know, but you can never say that it was me or anything. And that's cool. That's how a lot of articles are written. And but that's kind of for the FT or something what they probably have to do. They have to go and talk to people who might know and better understand that kind of stuff, you know? So, and they didn't do a 100% great job on it, but that's what happens, you know? Papers are things that come out all the time. They're not a book that's a final thing. There's always going to be some, you know, misreporting and stuff. You just do your best and you write your corrections when you did make a mistake.
Why do you think Buffett made the decision to have Greg control the capital allocation?
Because the company's too big and they've realized that the only way they can move the needle is with entire purchases or bailing out a company or something like that, right? Apple was a big investment thing, but since almost the last, 15 years, like around the time the financial crisis on, Berkshire's had to lay out a lot of money in acquisitions of entire companies or in things where there was a structure where you actually needed like a CEO type approval for it, probably more so than just a stock picker. So it's not just like a portfolio like you would run at most insurance companies. If he had kept it smaller, the company, then I think that you could have turned that stuff over to Ted and Todd. But, you know, go back and look at what the balance sheet was 15 years ago. Go back and look what it was 15 years before that. You know, if I'm saying like, if they had put the structure in place at the time of the Gen Re deal, they could totally have stock pickers like Ted and Todd run it all and everything. But the company's so much bigger than that, you know, Apple was like a 1 in a million opportunity in terms of it being such a big size. I don't know. You'd have to grab every one that was so big, you know what I mean, to make a difference. They would. You know, if Meta gets cut down to, you know, it had that huge stock drop, they'd have to get it and they'd have to rush in and act quickly and be buying hand over fist just to get a big impact on the company. It's going to be more deals that Greg could do that will just matter in terms of size. So I do think that's, and he kind of hinted that because like we can't have 10 people here all managing $20 billion.
Yeah. Mm-hmm.
And $20 billion is not a small portfolio.
No, it's not.
At any other insurance company, someone would be happy to be running a $20 billion equity portfolio.
Why do you think he sold down Apple? Is that a valuation thing? Is that a market thing? Is that because he thinks tax rates are going to go higher? He talked a lot about that, or hinted towards that, you know, fiscal deficits. Why do you think he's trimming Apple, right? Buffett doesn't typically trim. He's trimming this. He said that it'll still be the largest position in the portfolio.
That would be true if they're going to sell like 75% of it or something, you know. I mean, how much bigger was it than the other ones? I mean, if you have to listen to exactly literally what he says, you know, he won't say something that isn't true, but he also won't go out of his way to say, you know, to work out what he says to you so that you wouldn't get the wrong impression. You know, when people think that he when they get fooled by what Buffett's saying, it's because they read into it more the color of what he was saying and not listen literally to what he's saying. You know, he did not promise I'm not going to sell any more Apple or anything like that. And he didn't say that we might not cut it back a lot. What he said is I still expect it for a long time to be, you know, the biggest position. And he said, you know, that he also, I think, was kind of like misquoted around the internet or whatever. And that what I think he was saying is like the business is even better than the other businesses they own, like American Express and stuff. I don't think he said, oh, it's an even better stock than all the other stocks we own and stuff, which is fine. He could say that if Apple gets way overpriced. Apple's a great business. No one's arguing about that. So he's not breaking news with either of those things. It's by far the biggest position. So it's probably going to stay a very big position. That's not news. And Apple's an amazing business. He didn't say it's an amazing stock. That's not news either, you know? I honestly think he regrets not selling Coke and Gillette in the 2000s, and he's older now and probably doesn't want to saddle other people with positions that he doesn't know about. He'll be able to make decisions about and put them in the right place, and I don't think he wants them to be hurt the same way he was when he didn't make those decisions back then, right? I think rationally he understood to sell those things and didn't, and now he's like, well, maybe I can make that decision, but, you know, I'm saddling other people with that and stuff. So I wouldn't be surprised if it has some element of that. That could just be a trim, though. But, I mean, if half of your stock portfolio is in one stock and that stock gets overpriced, that can be a problem. I was talking to some people in Omaha, and they were like talking about position sizing and what do you worry about this and that. And I was like, look, what I've learned is the one that's the problem is it's not the position sizing at the beginning that is actually a big problem in managing money and stuff. What the problem is when you had something which was a big position and then it went up a lot, there's a lot of appreciation that caused it to be very big, then you get into a problem because you meant to make it a X position. It becomes 2X and more expensive when that's not where you're buying it for the first time. So those are the ones you have to worry about. And so that's why it's not how Berkshire does it, but just like money managers in general and stuff. Although it's irrational and stupid, the Peter Cundall approach of like, okay, it doubles, I'm going to sell half of it, right? And then people, is a good way to avoid having to face these problems, right? But for Berkshire, they love to buy and hold forever and stuff. So I think it's weighing those two against each other. I don't think they'd have trimmed necessarily if Apple was 1/10 the size or something. But as your biggest position, I think you might take it a little more seriously if it gets expensive.
Sure. What were your thoughts on Greg at the meeting?
Good. Very good. Yeah. We heard a lot more, I think, I felt like, from Greg and Ajit.
Yeah.
I don't know that he's going to bring crowds of the same number of people to Omaha for a long time and stuff, Maybe it'll still be, though, like where just investors congregate yearly, to go meet up with people and everything. We heard about how they work a little bit. It sounds, Buffett gave him praise. It sounds like no managers report to Warren or anything. No direct reports. It's basically all Greg is what it sounds like at this point. Yep, absolutely. No, I think he'll do a great job. But I think he isn't a face they're going to want to plaster all over CNBC and stuff for interviews and things. It's just not the same. And even Buffett, I think people would like the Buffett and Munger together. Makes for much more of a good show than Buffett alone or even Munger alone, And I think that was always true that those two together, for presentational skills and stuff is something that's, much more exciting for people. And I don't think the next generation at Berkshire will be that way, even if they have great execution and stuff. It will look more like other companies and how they talk, and people worried more about the financial results and the sum of the parts and things like that. Mm-hmm. And it'll become more Berkshire-centric thing about getting information about Berkshire and not about all other aspects of life. Yeah.
I just get the impression that Greg's really a meat and potatoes type of guy. It just seems to me like he's kind of a hard ass, who you would want to be in there, especially in a business like Berkshire. So I don't know. Yeah, I thought it was great. Buffett reiterated a few times during the meeting that hopefully Greg isn't going to retire for a very long time.
Yeah,
right? So, Buffett worked into his 90s and obviously Charlie did as well. You do think are other people like that, like what happens with Greg's succession? I think, did he say that there's somebody else that would take over?
Yeah. So there's someone like in the sense of like if he gets hit by a bus or something, they have that. And I think they've had that for a while. Yeah. But with Greg and Ajit both, they're not, they're at ages where some people do retire or retire within a few years at big public companies. And in fact, even Ajit, when they were talking about if he's replaceable and stuff, and he was talking about, Steve Jobs and all that stuff, and, Tim Cook was like, I'll leave the door open that I can retire at some point. I don't have to die at 90 something still doing the job. I felt like he was saying that, I'll stay, but we don't all have to work till we're 99 years old,
Yeah. Did Ajit say anything else that you thought was interesting as it relates to insurance?
Oh, lots of interesting stuff about insurance, but mostly things that we knew. Actually, we've talked on the podcast before about Florida. So obviously Berkshire did a big reinsurance bet on Florida, and that some of those are even basically, exposed to the same sort of risks that we talk about when we talk about like Universal or Heritage or whatever the different ones are there that are publicly traded. The hurricane risk there, they do Atlantic hurricane, which is not just that. Like actually, although people think of Florida, my guess would be Berkshire's normal exposure is like a direct hit to Manhattan or something would be the really big exposure. But in terms of frequency, it's things that hit Florida. Yeah. So that was really interesting. They made a lot of money on that. And they talked about how it's 1 year. And then you have to re-up each year and stuff. And, so sometimes when there isn't enough in the market to go out there and get that year, that's a good year for Berkshire. But then another year, there might be more coverage widely available, more reinsurance widely available. And so Berkshire's not active in the market. So it's when the price is attractive to them. Yeah. So I don't remember the exact numbers he said, but as you could see in that business, you can sometimes lay out, risk $1, and there's no big events, and you pocket 20 cents in profit or something on that dollar. I mean, that's the kind of math that happens there, but sometimes you lose the whole dollar. You know what I mean? Mm-hmm. And Berkshire is one of the few that are willing to do that in a big way, because other companies don't want to suddenly swing their exposure that much. You'd have to tell your shareholders, we had no exposure to Florida stuff one year, and then we had huge exposure the next year or something.
Sure. Let's head over to X and take some questions. The Rational Walk asked, what are your thoughts, if any, on Markel as a mini Berkshire and on Berkshire emulators more generally?
I'm more positive on the first one. I don't want to name names of here's the good emulator and the bad one on the other one so much. But yeah, Markel is a perfectly wonderful insurance company. It is different, I think, than Berkshire, but is more similar to Berkshire than other insurance companies. But it's also more similar to other insurance companies than it is to Berkshire, if that makes sense. It's halfway in between those. So if you're someone on the insurance side of things and know that, you're like, oh, Markel and Berkshire are really similar. This is real interesting. If you're someone who's all about Berkshire and not thinking always about the insurance stuff, Markel looks more like an insurance company than Berkshire. But yeah, and they have a what do you call it, like a brunch, in Omaha. Mm-hmm. They have obviously some shareholder overlap. You can see their portfolio, I think, in the like their 13F. I think it's certainly you can find it, but I mean, I also think it's followed a bit as sort of like a super investor kind of thing, like a Data Roma or whatever probably has that. And it is more diversified than like a Berkshire would ever be that way, but same sort of things as you might expect in like a Lou Simpson portfolio back when he was running money at Berkshire, for Geico, when he was running money for Geico. Mm-hmm. Yeah, it's long-term focused. I think it's interesting that way. I think it would be good for people to learn about Markel, but I also think, I know the Rational Walk has written a lot and knows a lot of stuff about insurance, but for most value investors, I think it would also help to kind of learn more about insurance and stuff before you just go headlong into Markel, and to start that researching of Markel and just learning more about how the insurance industry works and insurance companies operate as you do the two together. I think you need a little more insurance background before you hop into Markel as compared to Berkshire.
Do you think Warren is selling his highest cost Apple shares or his lowest? And what do you think the choice implies?
Oh, so he did. I have no idea, but he made this answer about taxes, right? Which is kind of interesting. Mm-hmm. You know what I'm talking about? Where they, he sort of talked about it as if it was a tax decision. And of course, that's really interesting because Berkshire has huge gains in Apple, right? Mm-hmm, mm-hmm. So it is a question of like, okay, so why would you sell things and pay taxes on it now instead of doing it later? If he thinks that rates are going to be a lot higher later, or just that things will be changed in terms of how you're taxed, then that would have a big impact. I think that's more, though, to me about the size of the position. I think, let me put it this way. I think if they taxed on unrealized gains and stuff, sorry, let me say that again. If there was a tax on unrealized gains, so you pay taxes even if you did not sell something, I think Berkshire's portfolio would operate differently, especially because it's a corporation and everything. Look, if there was taxes applied all the time to your gains and stuff, and they had the rates like they used to when Buffett started in this business where it was 50% and stuff, I think it'd be really different. So I don't know what it does imply, and I don't know what shares he's selling that way. But it is interesting that he seemed to give an answer that kind of went in a tax direction. I don't know if that was just to deflect away from saying anything negative about Apple with the CEO right there and stuff, or the price, or any of that, and he had to say something. But I do feel like, since it's your biggest position, you might have successors taking over at some point. He knows that you got to pay taxes on this whenever you do sell it. Mm-hmm.
Mm-hmm. This was an interesting thing. Someone says he said they are looking at something in Canada. What do you think it could be?
I thought about that too. I'm not sure.
Have they ever invested in Canada?
Yes, but not in any big deal that I'm aware of. And I don't know what it could be. I thought about that too. It's like, well, it can't be those things because that's too small. Then I had ideas for other things that are big, but then I was like, but that doesn't sound very Berkshire-y. So I'm not sure what it would be.
I could totally see like obviously too small, but like a Stella Jones type business.
I could totally see I could totally see a Stella Jones. Yeah.
First time I came across that company, I was like, oh, I feel like this is a company Buffett would be interested in, but it was just too small at the time anyways.
There are some financial services things in Canada that you could do. But there's some stuff that have overlapped that's a problem. I don't know if it's a problem, but I don't know that they would do too much in the financial services there. And then the really big things you could do in Canada are resource stuff, which Berkshire's not into that. Financial services, which they would totally be into and might consider, but I just don't know if they'll do the deals. And then the problem is that the stuff that makes a lot of sense for the right size, energy railroad, whatever stuff, he's like down on that stuff lately, right? And I don't think that we would hear that in the letter and then have a big transformative thing. I would guess it's a medium or smaller size deal. I don't think that it's a huge deal and stuff. So, but what you said in terms of the financial profile of like a Stella Jones, they would like something like that, but they probably want things that move the needle. And obviously they know the business because they're in both of the customers. They own things that are customers of them in both cases. Yeah,
sure. Buffett christened Abel as the chief allocator, as a CEO should be. He is a polished leader, but have we seen him allocate? ? Do we have evidence of any past allocation success? Does he truly understand the need for 10% return up front? Will he lean on Ted/Todd? I hope so. Fingers crossed.
Well, he's allocated a lot, but he's allocated in regulated and long-term industries and stuff, right? So that both in terms of the decisions that he made previous to working at Berkshire and then like being promoted up to the vice chair and everything, right, would be like that. And also just now Berkshire, a lot of it is in those industries too. A lot of what reports to him by number of units is in different diversified stuff. But in terms of asset base, we are talking a lot in utilities and railroads. So it's a different kind of allocation. Yeah. But Berkshire has allocated a huge amount in those things. Like Berkshire Hathaway Energy and stuff, for instance, is not paid out dividends and things. It's grown it. So on an allocation basis, it's huge compared to the industry. How much new money it's been putting out each year compared to what others do is actually really big. Whether we have success with that or what, I don't know, especially because, that's probably not been their highest returning type industry. And they've soured on it a bit with the treatment of wildfires and just other things, I think, in terms of regulation and stuff. They feel that it's a less certain industry than it once was. But he hasn't seemed to allocate into any fast changing industries and stuff, no. Or highly competitive industries. They're slow changing and very low competition, yeah.
So do you think he's going to be making the decision to, trim Apple or sell Coca-Cola? You really think he'll have full, autonomy over that entire aspect of the company? That seems surprising, doesn't it?
I don't think Ted and Todd handle Buffett's portfolio at all. So I think that the day that Buffett's not there, that portfolio gets turned over to someone. And I think that is theoretically, Greg. I'm sure there's no rule that says he can't farm out some of that or do other things or work in conjunction with someone else on something. I'm not saying that he actually is going to be going in there and saying, I'm going to sell 5% of this and buy that. He may not choose not to want to do that, but that authority will be with him basically is yes. Yep.
Well, next question. Buffett is seemingly quite concerned about an increase to corporate tax rates. How much is #Geoff concerned about that? And what does he think are the best ways to invest around that risk? International, liquidations, merger R, bonds, business with lots of NOLs, MLPs, etc. So are you concerned about corporate tax rates? And then I guess how do you mitigate those concerns?
I don't know if I'm concerned about it. Taxes need to be higher and spending needs to be lower, or to make a less political statement, some combination of lower spending and higher taxes or whatever. They don't both need to be changed. You can change one without changing the other. Whatever, you can change them both a bit. But, that's what you have to come to as if you don't want to run huge deficits and increase your debt all the time, you have to do that, right? So what is logic?
Both the two candidates are. I mean, they spend like crazy. So I don't. Is that going to happen? Are they going to control spending? Probably not. Are they going to want to raise corporate tax rates? Well, at least Trump wouldn't.
Yeah, but does raising corporate tax rates more palatable than raising, say, personal income tax, or raising or changing the treatment of dividends or capital gains, or raising limits on what you tax in terms of payroll things, or changing treatment of this or that? Or look, you can tweak it. You can come up with quite elaborate plans. You can. When I shouldn't even say that you have to raise tax rates or cut spending, raise tax rates or cut spending or whatever. Some of it can actually be structured in a way that you don't even have to say that's exactly what you're doing. You can have the same rates, but more stuff gets taxed, right? You can that is, in other words, you can use the term that you're closing loopholes and stuff, which means that there's a bigger tax base that I'm actually collecting on and stuff. Or you could have the same base and tax more and stuff. So it's a political decision at the end of the day, right? Like, what's the best decision? Should it be sales tax? Should it be, which there is not federal sales tax in the United States? Should it be taxes on corporations? Should it be taxes on something that isn't earning stuff, whatever? Usually taxes that already exist, and then moving the rates is easier. And usually doing it for people who aren't critical to your winning or losing an election is really important. Corporations are not important from a political perspective of winning an election. The candidate that annoys every corporation is still quite capable of winning an election in the United States, but they do lobby and may make it difficult for you to get things through Congress and whatever stuff and all of that. But you can certainly run on a platform of, I'm going to raise corporate taxes to the moon while doing other things that help other people. It's not a vote loser in the United States, I don't think. So they could do it or not do it. I really don't know. I mean, logic is a part of it, necessity. And logic, they talk to their economists and get advice on what it would mean for the economy, is a part of it. And the political calculus is a part of it. So I'm saying there's a necessity part of it that's true. And then it's just a question of what your advisors tell you is the economic thing to do and what your political advisors tell you. And the economic advisors are not going to be given more than half the weight. The political advisors will be given half or more of the weight in terms of what decisions to ultimately make, I think. Mm-hmm. What do you think about that?
I think he is concerned about.
Oh yeah, no, and I'm concerned too the way that he is. Yeah. But I mean, how do you actually? When people ask this question, I say, look, who's going to pay the tax and stuff? I don't know. I mean, like, there's two parties. They usually are pretty close to 50-50 in terms of their chance of winning an election, and there's two houses of Congress that their cycles don't exactly meet up that way. Some things are pretty hard to predict. Some are not as hard. I can predict, for instance, it would be hard for Democrats to have strong majorities in the Senate going forward because you can look at a map and see that's tough. But like predicting the House or the presidency, that's way more difficult because the math is just way more difficult. It swings so much all the time. So you can't even predict which party it would be. And if it's divided up between different parties, they have to work things out together. Because the president can't sign an order that changes what the taxes are, nor can Congress usually override a veto. They can, of course, pass things themselves without needing the president's approval. But the way it works in the United States, you pretty much are going to need something because the political environment is so equal. The two sides are very equally matched. That it tends to be that you need something that both the president and both houses of Congress can actually get through, which is some sort of compromise. Right, that's politically expedient for both sides, and that your kind of economic advisors say is not insane.
What did you think about that? What Matt Hansen had said: for the first time ever, I didn't see Buffett take a sip of Coke nor a bite of C's.
Yeah,
what's that? What's the conspiracy theory there? What do you got for us?
I don't know. I mean, because I know he doesn't have, like, if he was a PR type, if there was a normal corporation, right? They would say, don't you dare take any of that peanut brittle and stuff, their PR firm that they hired. Right? You're going to look silly out there eating it. There's going to be some sort of gaffe. You can't do it, right? Yeah. So, the Hollywood executives
usually hear Charlie Munger in the background just chomping away through the mic.
Yeah. So it wouldn't surprise me if Bob Iger sits there and never takes a sip of something because there's someone backstage telling you have something in your teeth or something last meeting, right? But I don't think that that's it for Buffett. So I'm not sure what that is. Yeah, the only thing, of course, could be age-related things and stuff like that in a public whatever thing to be doing this. But I don't know.
Maybe also, I mean, I don't know about the drink part, but like the C's part, he was running the show entirely himself. I mean, he did defer some questions, but he didn't really have somebody else that was just going to monologue. I mean, they did a little bit, but, you know, he was just running the show. Maybe he was just really in the zone. You know, sometimes when you're just really in it, you're just not thinking about food or drinking or anything like that. So I don't know.
Yeah. Historically, Buffett, not a coffee drinker, and has drank his whole life caffeinated soda. So I'm sure he drinks, you know, historically, I don't know now at his age and stuff, but there's no way he wasn't knocking back 6 of those a day on average in the past, you know. And that wouldn't change overnight.
You don't think he... so you're
saying
he
does
that,
normally.
Yeah,
I don't. Maybe he's changed his diet and stuff,
yeah.
but absolutely throughout most of his life, there's no way that Buffett wasn't drinking a 6-pack of Coke or Pepsi at the time, because he doesn't get caffeine from something else, and he's on caffeine from having those things, you know. So
6 sodas a day. Good Lord, that is horrible.
I would think so. Yeah, I would think so.
That's crazy.
I mean, it's still,
and he was like a bean rail, you know, for like most of his life. That's the part that generation, dude, they could just put down stuff. And you look at all these old pictures of people on, you know, in the 50s, 60s, 70s, everyone's just skinny.
Yeah, he doesn't have a balanced diet, though, so he doesn't eat a lot of the other things. So you add it all up, it probably doesn't add up to a radically different thing. I'm not saying everyone should add 6 cans of Coke on top of what they're already doing, you know, but I'm saying that, yeah.
Yeah, so you're saying, okay, so he drinks over 1,000 calories a day of soda, but maybe he doesn't eat a bunch.
Yes,
so
I think from what we've heard, sometimes
2,000 calories.
Yeah, sometimes he might wake up and just have a bowl with some ice cream in it and nothing else till the afternoon or whatever. You know what I mean? That's what it sounded like. Yeah, high amount of snack food type stuff that he has, and a low amount of your, definitely a low amount of your vegetables and stuff. Yeah,
crazy. Okay, next question. Greg Abel. Am I pronouncing his last name correctly?
Abel. I say Abel, but maybe
okay. I don't know. Greg Abel. The culture will not change. He quotes him. Has the culture ever been written down / described in a concise manner to be able to judge in the future whether it has been preserved? I don't know. It's kind of like one of those things where you know it when you see it, you know? So yeah, I think it'll be pretty easy to tell.
I think for the shareholders and stuff, with the owner's manual and all that, it has been written down. In terms of what the attitude might be about how the operating managers feel, that's more unwritten. So they may feel that it's changed, you know, that he's given them more oversight actively than Buffett used to and stuff. Maybe there's some of that. So I could see the executives thinking it's not written down and there's not necessarily a culture there that way, but how you treat shareholders and all of that, I think that's pretty much written down and everything. Mm-hmm. I could only imagine the biggest difference being the people who report to the direct reports to Greg and to Ajit that might think that things will change or have changed.
Mm-hmm. Do we think he is correct in sending people down the treasure hunt rabbit hole with 50% a year expectation when the barrier to entry is not 3,000 hours of reading security lists at the library, but a 5-minute screening in a free finance app from the sofa?
I agree with
age-old question with Buffett, being able to put up 50% a year numbers.
I agree with him. I manage a very small fund, and if I could manage, 100 times less and it was all my own money, I could do better. So you don't want to say that to people. You want to say, oh no, of course the professional thing, managing that. But look, if you dedicate your life to it and you have a few $100,000 of your own money, there's things that you can find that no one can do when they're doing millions and stuff. But he did say, look, it doesn't matter if we have 10 billion or 200 billion. It's the 10 billion versus the 20 million and stuff that matters a lot. You know what I mean? Like he was saying, that you can do this with your personal money, but it isn't something like Berkshire's in this big disadvantage versus institutions that are, whatever size. But we've talked about this. I think you and I have talked about this off the air more. I actually think there are quite a lot of inefficiencies in very small things that are specifically stuff that doesn't show up in the numbers yet. So in some ways, I think the market has gotten less efficient. But in other ways, it's quite efficient. Running the Geiger counter over it to find things that are already in the finances, it's quite efficient with that. But I actually think since I started investing to now, it is less efficient in being able to see things and predict it ahead of time for companies that they're telling you, like really banging a gong and saying, here's exactly what's going to happen in the future. They're just not saying it in numbers that show up in the financials yet. And people just don't care because they're like, look, the computers and stuff can only see the numbers. So what does it matter? Right. So you just wait for that. And so there's so many things where I think that's true. And we talked about one, then we talked about momentum. So things that can be screened using your QuickFS and your Guru Focus and your Morningstar and your whatever, sure. But actually learning about a small business, and Buffett did a lot of scuttlebutt in the early days and stuff. So no one's putting in the legwork. I do feel that. I talk to many wonderful people in Omaha and everything, but everyone wants to look at the numbers from the sofa and not get out there and actually figure out the story and stuff. You know, Buffett says you assign yourself the story of the stock and really figure it out and everything. No one wants to put in the extra legwork and stuff. There's no rule that says you're only allowed to use the summary financial information and stuff that can be in Capital IQ. You're allowed to go out there and get information and to figure out what to buy and sell based on that. That's how Buffett did in his early years, and that's what you can do with your own money if you're in like nano cap stuff. I do believe it's quite inefficient. Mm-hmm. What are your thoughts on that one?
I sort of agree. I think if it's on a screener, it's probably, it depends what type of screener you're running, but I think that's a good way to lose money. I always say, like, I think, you know, buying cheap for cheap's sake a lot of times is kind of not that good. It's probably cheap for a reason. There's companies that have been cheap since I first got interested in investing, and they're still cheap today, right? I really think you need like business momentum. And you are right, though. And what you're referring to, there's some smaller companies where analysts may not follow it. People may not be interested in the industry or the sector. If you follow like the transcripts and what they're talking about and sort of their guidance, even though not guiding towards numbers, just generally like what the business is going to do and what their thoughts are on the business. Sometimes it may not be evident in the numbers until it comes out, right? And there are some names, some businesses that we've owned or have followed where you just know they're going to go through a bad year or whatever. And you're like, yeah, I mean, it's probably they're going to come out with bad news that they've been talking about. And then they come out with it and then the stock price sells off and you're like kind of surprised. You're like, this has been known. They've talked about this for months or last quarter or 2 quarters ago. So yeah, it's an interesting debate. I don't feel like that's the case in larger companies. I think it's smaller companies. That's true. But I think business momentum is really important, right? Buying cheap for cheap's sake. I like to have business momentum attached to that. Otherwise, you're just going to be kind of waiting for something to happen, you know. But then sometimes something does happen. Look at MLP, right? That thing went nowhere since 2008, but there was an inflection in the business. You know, the animal spirits start to get going a little bit, and then the stock re-rates. But
absolutely,
I like to see an inflection in actual business itself, some sort of change, you know.
Yeah, and just even with the giant stocks, the Teslas and the Dollar Generals and the Metas, I was just disappointed in terms of, I felt that, you know, some people I'm sure did great write-ups of it, but analysts just not getting out there and seeing what's going on and seeing what management's saying and saying, look past the numbers and try to figure out whether we're at a point to really change things and stuff, and not to wait and be surprised. And I am surprised sometimes when we see that the market is surprised on a stock that is heavily covered by analysts who could be out there trying to count inventory and see what what's really happening and stuff. It's just so visible and stuff, and just waiting for the surprise for the company to report its numbers. So yeah, but in the actual numbers, the Ben Graham type stuff, yeah, that's arbitraged away. I would agree with that. If you can have it in the statements, then it disappears now.
Do you think the job of what an analyst should do has changed over the years? It seems like a lot of times, you know, some analysts may be afraid to ask the hard-hitting questions to management because they don't want to lose access to them. Yeah. It's like, I feel like when you read these books from, you know, years ago, it sounded like they were much more confrontational than they are now. And now it just seems kind of like they're lobbing them questions oftentimes.
Yeah, but that is a problem in journalism too.
Or more modeling type questions. You know, they care about their model and all that.
Yeah. I mean, what we'd be interested in and what we would pay for and stuff as a research service is not what makes most analysts money over time and stuff. So it's a different side to it than, you know, of what their job is and what we're talking about. But really digging up the story and without making it about the things that you can find out in you can find out in financial statements would be pretty helpful for some extra value that analysts could provide for you. But you know what? There's probably fun. I mean, like I'm saying all this, but it's the stuff that we see inside giant hedge funds and stuff. Maybe there are people, the analysts working for the portfolio manager there, who are doing a great job of figuring out things about Dollar General and Meta and Tesla ahead of time and helping those funds trade it. It's just that the analysis that we see put out for research analysis stuff that firms are putting out and stuff is the stuff that I'm talking about. So I'm not saying that no one's doing this research and stuff. I'm just saying that we're not seeing it circulate in a way that's changing the discussion that's helpful, and maybe the way that we did when that was a more important job, maybe in the very late 90s, early 2000s. I mean, the analysts that were on those calls there, that was a big job in the dot-com boom.
Sure.
Yeah.
Mm-hmm. Let's see. Have any fully owned Berkshire operating businesses improved their competitive positions? Obviously, they buy good businesses, but easy to see the relative slippage at Geico, BNSF, margins, PCP, Johns Manville, etc., with few counterexamples. Nothing awful, but makes you wonder.
Yeah, that's a good question. I'm not sure which ones have improved it. Geico, from Berkshire's investment in Geico on, did really well. It improved its competitive position big time. After Geico merged with and stuff, with Berkshire, it also did well. But then you have all the slippage and stuff recently now. But if you were talking about from 1980 to 2010 or something, Geico really did quite well, and Berkshire either was the biggest owner or actually had merged with it. So I think Geico improved their position. I don't know that Geico would have for so many years been so big in all the advertising stuff if they weren't backed by Berkshire. They may have been, but they were already, even before Berkshire took them over, Berkshire was such a big shareholder that I think they were more comfortable with going in that direction. So yeah, but I agree that generally this is not a situation where they're brought into Berkshire and then they improve their competitive position over time. I can't think of a lot of cases where that would be likely.
Mm-hmm.
These people sold out to Berkshire, so and then they're not capturing as much of the economics for themselves as the owner. So I don't know. I mean, I think usually when you're a financial buyer, you don't see a lot of improving competitive position while you're an owner and stuff, usually, because you made your money by someone giving you a good price on selling, right? And
were there really no questions about banks and bank stocks? What a missed opportunity. That was a question. Is that true? I mean, now that I think about it, I don't know if there were any questions about banks.
I find this fascinating because does it feel to you like it was only however long ago that the banking crisis happened and stuff? Because some of that stuff we were talking about, like while we were in Omaha, right? Is that right?
Sure.
Do you remember?
Yeah.
There was, I forget all the different banks, but it wasn't, at that point, it wasn't First Republic and stuff, but there was a couple banks. Was it Western Alliance? I forget. There was a couple banks. Yeah. So there was 2 or 3 different ones at the time. Their stocks were flying all over the place and stuff. It was in the news constantly. And then the next time you're in Omaha, it's like, who cares and isn't asking about it and stuff, right?
People move on quick.
Yeah, I mean, look, what happened is when rates went up, everything was the move in it was all explosive and it was big news and everyone was excited about it. Now with rates pretty flat, no one's that excited about bank things one way or the other, right? Things aren't exploding and big opportunities to buy distressed things, and yet also their earnings aren't going up, right? So it's kind of like a commodity thing. Like, if the commodity goes from $10 a ton to $60 a ton, people talk about it. If it goes from 60 to 5, they talk about it. If it goes from 60 to 60, they stop talking about it. It loses all its sex appeal, right?
Mm-hmm. It's weird though, because I mean, in my opinion, I think banking should be on people's minds a little bit because of where rates have gone, right? So yeah, there were failures, but I do wonder what's going to happen to a lot of these investors or companies or whoever, where banks lent money and they're going to have to refi at much higher rates, right? Like what's going to happen to those banks and what's going to happen to like regional banking in general? Are there going to be more failures? Is it going to be a very tough time?
My honest answer is that this is a value investor gathering basically, right? And if you look at what value investors own and everything, I think the double whammy of the financial crisis and then the rates going up and squeezing the net interest margins and stuff later, value investors are like so over banks. They don't want to hear about them. They don't want to look at them. It's just they want to put in the too hard pile. It's no longer, when I was talking, value investors in 70s, 80s, 90s, 2000, like banks were one of those things, and a lot of old economy stocks and things. So banks are one of those things. They're somewhat cyclical. They get a little too cheap. You can evaluate them based on price to book. Many of them pay a good dividend. It was a constant thing they rotated in and out of, and was just a normal part of value investing. And now I just feel like I hear so many more value investors just go, that's not an industry I want to be in.
Mm-hmm. Yeah.
Which is funny because Berkshire said, like Buffett was like, if the rules hadn't changed and stuff in those early years where we got into both National Indemnity and Illinois National and stuff, the Rockford Bank, we could have been in banking instead of insurance. It was changes in regulation and stuff that made it end up being much more exciting for us to be in insurance than in banking. But early years, we were making better returns and stuff. It was an easier business initially to be in the bank stuff. There were some more growing pains in the insurance side than they had experienced on the banking side. But it was changes in regulation, things that just made insurance so much more a better thing to build as a platform and stuff than banking. But early days, they didn't know which one they were going to be in.
Mm-hmm, mm-hmm. What are your own thoughts on capital allocation at Berkshire and how they should balance the current opportunity set with an elevated cash balance post selling Apple shares?
I mean, I don't like to criticize and stuff, so I don't want to make hot controversial takes and stuff. I think that they're too big, and that the time to have said this is it and we're not going to get past this was a bit smaller than where they are now. And I think that in the long run, I don't know that Berkshire will be that much better than if Buffett had just bought his big Apple chunk and stuff and then said, we're going to kind of change how we're going to do capital allocation going forward. Might be some more buybacks, some more dividends. We're going to realize that this is a size constraint that we probably don't want to go much past this. Let's give Ted and Todd more of the portfolio to manage, but have the idea that it won't go where we're managing infinite amounts of money, but maybe they could each manage a common stock portfolio if that portfolio was more of $100 billion, and was never going to get bigger than that or something. I think there are advantages to not splitting up all the different businesses, right? And there are advantages to not paying a regular dividend. And I think that's especially true on the insurance side, the power of that. But none of that says you can't sometimes return capital intermittently. It doesn't necessarily mean that you can't still have a fortress balance sheet and be in a strong position in a crisis and have the ability to flex on the insurance side more than is normally the case.
Mm-hmm. A lot of these questions we have left, we've sort of hit on. Okay. Let's see. Here's an interesting one. What do you think would have become of Munger had he never met Buffett?
That's a very good question. I don't think he'd be a billionaire. I think he would have retired quite early.
Yeah.
I think
he retired since his 40s.
Mm-hmm. I think he would have been a bit more of a hard charger. I think he would have ended up doing more in probably real estate, even more than he probably wanted to, just because that's something he knew, and he'd be tempted to do that for a while. But then I think he'd get fed up with those aspects of that kind of stuff, and he would have a savings that was big enough that he could do whatever he wanted, and he would be a more inactive and low profile sort of person. But I would have guessed really aggressive 15 years of wheeling and dealing and making money, and then retiring fairly young on a much smaller amount of money, but for an individual of that time, kind of a small fortune. Yeah, that's what I think. What do you think?
That's probably true. He made a small fortune at the time, even before Berkshire, right? So I agree. Yeah. I think he probably would have just kept and doing real estate deals and doing that way. I don't know if he would have gone the hedge fund route or anything like that, the partnership route. But yeah, I agree. To me, I think he enjoyed being a man of leisure and reading and studying. I mean, Buffett talked a lot about that, right? Reading a bunch of different biographies. Munger would always say, I don't need to have dinner with the person. I already spent time with them through the books that he had read. He didn't need to have dinner with Benjamin Franklin. He just knew all about him from his readings. I think he just his life would have been set up the same. He just wouldn't be as wealthy as he was. That's probably a fair guess.
Yeah. And I think he might have done less in common stocks.
I don't want to take away from Munger. I don't want to take away from him too, obviously. I just think he probably wouldn't have compounded for as long as he did.
I think one thing that Buffett has said many times and gets underappreciated, right? Is Buffett's like, I had a much narrower focus than Charlie and stuff. Buffett is not just, is very smart and can figure these out and stuff. Look, most people, even if they're absolutely brilliant, understand everything about the stock market, know exactly how to make a ton of money and stuff. The truth is they don't stop because they can't make money anymore. They can't beat the market anymore. They stop because why would you keep doing it, right? Like the novelty of the game has worn off. They have more money than they usually have so much money that's causing them problems in their life, right? And they're like, you know what? I'd like to trade some future wealth for some peace of mind and for some novelty in doing other things in my life that I've wanted to do. You only live once, you know? And so why just stick with that the whole way through? Buffett is not just that he's a genius and stuff, but that he basically dedicated his life. You know, he always was looking at stocks even before Columbia, but let's use Columbia as the start date, right? Because when he goes into Ben Graham's class and from that point on, he's totally obsessed with one way of thinking about things. And that is the main focus that way. Okay. No one dedicates all of that portion of their life, the vast, vast majority of it, to that one focus and trying to do the same sort of thing. If the game had never changed, he might have stuck out doing Ben Graham type things. If he always managed a small amount of money, if the market hadn't changed, whatever, I don't know that we would have seen this transition to all these other different ways of thinking. I think Munger would have gotten bored doing what Buffett did for as long as Buffett did it. But that willingness to be as bored as Buffett is doing that is what made him a mega billionaire, and why even people who are as smart and hardworking can't keep it up for decades. They want to move on to a new phase of their life eventually.
Did you see Munger's last interview with Becky Quick?
Yes, I did.
Something that was interesting that he talked about was, I think she asked him if he had any regrets. And he had said that he wished, I don't know if he said like he wished he played the game harder, he tried harder, but basically he said he could have been a trillionaire, I think. Did you hear that part? What do you think that was all about?
I think there's some stuff that I think it's similar to like where Buffett and Munger say, you know, like take your risks when you're young and stuff because you can afford to lose then and stuff, you know. I think there is an awareness later on in life that if you had worked super hard for a short period of time on certain things that could have made a lot of money early on in that snowball, right? That phase of it is so critically important. Jacob McDonough wrote a book about Berkshire, and what I always stress to people at looking at it is, since they look at the compound annual result over the entire time, I think they leave out two really critical things that don't pay enough attention to. And also because he wasn't writing the letters for those years. They had a good price that they got in it, and then the stock changed so that it's traded at a premium to book a lot of the time versus it had been under book. And that sounds like, oh, that can't matter. That's just one time. Yeah, but it matters because then if you take book value and you 100x it, then you're also 100xing that change in those things. I've said that about Activision. Like it was a 7x for me in terms of valuation. People go, oh, well, that's a lot of money and stuff. But no, it's 7x and it compounded. That's a huge difference in terms of the result. And then the other thing that they did is they worked super hard those first few years in getting cash out of the textile business and putting into other things, right? So that's an example where they did the kinds of things that Munger, the kinds of things that many people regret, like, okay, that not doing. They could sit on a little too long and stuff, right? And so back in that period, whether it was them doing that at Berkshire, and I think they really did that with the Buffalo Evening News, and Munger was very involved with that. There's some very high pressure situations where making those changes were super important. But over time, it's a lot of work and a lot of unpleasantness to do some of those things. And Buffett and Munger, I think, both could do the math. And so looking back, they can see, oh, if I could have gotten a bit better outcome here, I then could compound on top of that and everything, and the result could be a lot better. And it makes a huge difference in those early years. I can't imagine that Munger was talking about, oh, I wish that I'd worked harder when I was 70. But I wish I got started earlier on the things that had the best returns for me and focused maniacally on them when I was 20s, 30s, 40s, whatever, you know, because that can make a huge difference. Yeah. And Munger's a little bit older. He didn't make the transition as fast as Buffett did. He always kept one foot in the law and stuff for a little while there. You know, I just think there's things where...
That's probably why.
Yeah, I think he may have felt he was putting 80% in when he should have been putting 110% in. But, most people would rather put 80% in and have some slight work-life balance and stuff. than 110% in and be like, yeah, but I can get to that later after I make a lot of money. But also remember who's giving away money, by then. And so you do start to realize like, oh, I could have given away a lot more money and everything if I had just done that earlier, It's funny reading like The American Capitalist or something where people are complaining to Buffett, like, what do you mean you're not giving away the money now that you're still going to compound and everything? That's so silly. You look how much you already have. That's ridiculous. Well, if you do the math on how much more he ends up giving away, and when he actually did the stuff with the Gates Foundation and everything, it added a lot more to it. So, yeah,
made a difference.
But I mean, I think that happens it happens with anything. When you're really early on, you're always like, oh, say we have a fund and stuff, right? You're like, oh, when we're managing X amount, then we'll be set and everything, And then you get to X and you're like, oh, well, then when it's 2X, when it's 3, whatever. So of course, early on, you're like, oh my God, I have $10 million, I have $100 million. Now I can really rest on my laurels and stuff, right? Mm-hmm. But later on, when you have billions, you're like, oh, it was easier back then. I should have been putting the work in then when I still had these great opportunities and stuff, and could have really made a difference when I was a lot more energy. And I think for Munger too, he would always say it was easier back then. Like, I think he had, I don't know if it's a regret, but he looked back and was like, that, the 1970s and stuff was such a golden age for us, and you needed to do everything you could back then. Mm-hmm. If we had known how hard it would be 20, 30 years later, maybe we would have been like, oh, we've got to do every deal and push everything as far as we can because we'll never see these prices again.
Mm-hmm. Well said. Well said. Any final thoughts on the Berkshire meeting, Buffett? Any thoughts about the stock, where it's currently at, the future? Yeah. I mean, what happens after Buffett's gone?
No idea. We talked about that. I mean, I think there's two things, right? We just said that there's what people are telling you, what they might want to do, and then there's what I'm saying is just the cold hard math of it longer term. Like, I would just get the back of an envelope or whatever and do this in terms of saying, okay, how much do you pile up in 3 years, 5 years, 10 years? This happens with stocks where they're like, we don't pay a dividend, we don't intend to. And then you look and you go, well, you're going to have to pay a dividend, or you're going to pile up a ton of cash, or you're going to pivot your business totally in a different direction. And I'm not saying they don't want to keep to the pattern that they've had before, or that these people aren't as committed as the previous generation or any of that. I'm just saying, look, this is the math. You're going to have too much cash, and it's not going to be a problem that's going to go away. So you're going to start needing to soak it up. Now, after Buffett's gone, maybe there's no way to know this. Sometimes the market surprises me this way, but maybe there becomes more of an appetite, a willingness to sell over time, and a willingness to have more churn among the public and stuff, so that it is more easy to return capital through buybacks. And maybe this thing starts to look more like a Teledyne or a John Malone company or whatever, where there's a lot more interesting financial aspects to it instead of just a steady thing over a huge period of time, But we'll see. I don't think Buffett's ever had enough of that appetite. The market's never been as willing to sell him as much stock as sometimes maybe he's wanted since he talked about the buyback.
Got it. Cool. Well, I want to thank everybody so much for tuning in with the both of us on the Focused Compounding Podcast. Thank you to everybody that sent in questions. If this is the first time you're joining us, be sure to hit that subscribe button wherever you're listening or watching. And of course, the best way to get access to everything we put out into the investing universe is to follow me on X at Focused Compound. I want to thank everybody so much for all the support, and we will see you in the next podcast. Take care.